My name is Frank Biaggi. I'm the CEO of Biaggi Life. Today, we're going to be talking about whole life insurance versus IUL, which is indexed universal life. And I've seen a lot of videos on YouTube, and they talk about a lot of people are pushing whole life. Some people are pushing IUL. I look at a lot of companies at Biaggi Life. We look at 40, 50 companies. And what I'm doing is taking what I have found to be one of the best whole life policies from an A plus company. And I have taken one of the best IUL policies from another A plus company. And I want to compare them side by side and just see what it is about these policies that would make one more attractive to the other, if that's possible. So first, let's look at the whole life policy, and I'm going to put it on the screen for just a minute, and let's look at just the features of it. So what we found from looking at that whole life policy is that the minimum annual premium was $7,870. The cash value for the first year was zero, which is pretty typical of whole life policies. The death benefit is 500,000, and in 30 years, the cash value was 319,165. The death benefit was 594,420. So now let's look at an IUL policy in direct comparison and see how that stacks up. So if we look at the IUL, what we find is that we're running the premiums the same because we want to do an apples to apples comparison to see which one actually performs better. So at the same premium, $7,870 a year, the cash accumulation value is 6,508 versus there was no cash value in the whole life. So the cash value in the IUL already was way over 80% in the first year. The death benefit was 506,508, which was the 500,000 plus the accumulation value. And in the 30th year, the accumulation value was 440,525 compared to 318,000 for the whole life. So it had considerably more cash value accumulation value. And the total death benefit was 940,525 compared to the whole life of 594,420. That's significant. And the reason it was so much more is because it again on the IUL, and included the 500,000 plus all of the accumulation value. So if you go back and you look at the whole life policy, the whole life policy only had 319,000 of cash value, and it had 594,000 of death benefit. Here's the problem with the whole life policy. They keep your cash value. So when you die, you get 594,420 in the 30th year, but they keep your 319,165. That was a problem that whole life policies had prior to universal life that came out in 1979. And to my amazement, they still haven't fixed it. You could justify buying a term and invest the difference if you did invest all that money over a whole life policy. But it wouldn't work with an IUL because the IUL had 440,000 of accumulation value in the 30th year, but you get to keep your death benefit of 500,000 too. So you'd have a total death benefit of 940,525 with the IUL, blowing both of those other concepts, the whole life and the term and invest the difference, out of the water. There's no comparison. The Achilles heel of the whole life is that they keep that cash value when you die. So you don't get it in addition to the 594,420. The reason the death benefit went up to 594,420 is because they were buying paid up additions on that policy during that 30-year period of time. But it wasn't enough to make up for all the accumulation value that you're losing if you did in fact die. With the IUL, you get to keep your death benefit for the rest of your life. I haven't talked about some of the other features on the IUL over the whole life, but I do want to bring those up now. The whole life minimum premium was $655.81 a month, or $7,870 a year. I just matched that premium with the IUL to show you what it would do on an apples to apples basis. But the IUL had a minimum premium of only $168.75 a month. That's about 75% less than the minimum premium on the whole life. So you could buy an IUL policy, and let's say you couldn't afford to make that payment, you would only have to pay about 25% of that premium and keep the policy in force. So it's got a much lower minimum premium than a whole life, which provides safety to you as the insured because you're not going to lose the coverage. It also had a no lapse premium that guaranteed that on this particular policy all the way to age 90. And I've already talked to you on other videos that you have an option with other companies to guarantee it all the way to age 120. So this one has a no lapse guarantee all the way to age 90, where it can't be increased, can never go up. And that's about 60% less than the minimum premium on the whole life policy. So it has a lot lower premium options than the whole life policy. The IUL, you could drop down to minimum and you could just pay minimum premiums and just have a very minimal cash value in that policy all the way through. I've heard people say on YouTube about IULs that if you do the minimum premium, oh, you're going to lose the coverage down the road. You won't lose the coverage as long as you keep the premium increased with the amount of the cost of insurance. So even if you paid a minimum premium, you just have a minimal cash value, you can always increase your premium down the road just to pay for your cost of insurance. And it's going to be at a very low annual renewable term rate for the rest of your life. So the IUL just gives you options to keep your coverage, manage your premium, reduce your premium without losing your death benefit, and maintain your death benefit the rest of your life. The term and invest the difference doesn't do that. And the whole life doesn't either, because that's this great big huge minimum premium that you have to pay. And then you lose all your cash value when you do die. If you got to keep the cash value with the death benefit, it would still make that whole life policy a lot more attractive. But the fact that they keep the cash value, it's just the Achilles heel that just destroys doing it that way. Now, IULs are very flexible. So you can set them up many, many different ways. You have a minimum premium, no lapse premium. You have maximum premiums under TAMBRA laws and various things. So you can set them up all kinds of different ways. And if an agent is setting that policy up incorrectly, it can be a problem. So the agent has to know how to set the policy up for the application that the policy is being used. The IUL product itself is great. You just have to know how to set it up right. And you have to always be trying to set that policy up to maximize whatever the client's trying to accomplish. And you can do that with an IUL. Some policies have real low minimum premiums. Some people don't, some of them don't. No lapse premiums vary company to company. Some are real competitive, others aren't. So each policy is different and each company is different. But the IUL is a great plan. My name is Frank Biaggi. I'm the CEO of Biaggi Life, and I look forward to seeing you next time on Let's Talk Life.